In this video, I would like to present to you the two key elements of Gabel's Dalhousie Package Pro. First, the trend recognition, and second, the market phases. So what prompted me primarily to go from the market technique to Dalhousie, or to get to the know-how of the Dow theory? It was all about questions such as, for example, should I use 4 trend sizes, or is it actually just 3 according to Dow theory? Which is better? Should I take the high and low points in the chart, or perhaps the closing prices? Or is it better to take both? And in particular, the third question, which is then described in the next video, isn't there an easier way to do it, a more stable and clear way? Let's take a look at the difference between the market technique, which works based on high-low, and then also the closing prices of the Gabel add-on, the Gabel perspective. Displayed here you can see the highs and lows and the trends, which are the result of the 1-2-3 scanner accordingly identifying the highs and lows. Take a look at these corresponding trends, and next we'll take a discovery that works based on closing prices, just as I have worked up until now in my Gabel add-on. You can see, for example, here, that of course we've identified the highs and lows at the closing prices. And if you just select this area right here, then you can see that this trend here, for example, was broken and remains stable with closing prices. Other trends around it are exactly the same. And this is a big difference, whether I'm working based on highs and lows or on closing prices. The fact is that this view, the market technique view of the trends, is technically correct, since of course the highs and lows are also where trading takes place. Just that anyone who's aware of these high and low points, so the point 2 and point 3, will at some point realize that working with the closing prices makes the trends considerably more stable, because as we've seen, they're not broken so quickly. Because often at these 2 and 3 points, only the stop orders and entry orders are simply picked up, while the trend really remains intact. This of course has a grave impact on all conditions, which are built upon these 1-2-3 detections. And this was the reason why I chose to work based on closing prices. But now the question is, what is better, to remain technically correct or to work profitably in the markets? And it's this question that I've delved into. Let's take a look at a further example. This is the trend 2 according to high and low prices, meaning that it was really the highs that were aimed for here, and with that this downward trend would naturally have been broken, because we're working with high and low here. But if you regard the whole thing based on closing prices, you can see, aha, the trend would remain intact. Here it was no longer possible to take this leap downwards with you, but based on closing prices, the downtrend remained intact, we had our stop, and we still remained in the market. This is the big difference between high-low and closing price basis. Now, what are the requirements for a signal, and what has been achieved with this Dalhousie setup? Here the following was conceived, that precisely these high and low prices should be combined with closing prices, and accordingly the trend phases also had to be completely redefined for the 3 trends, no longer 4, but for 3 trends. Now I'll show you what the trend phase 2 consists of. Trend phase 2 arises when a trend break has taken place, but no new valid trend has formed yet. For a valid trend, here there was this trend break. For a valid trend, a lower low has to be formed here. Only then would a trend really be valid. So this is what the trend phase 2 means. For our trading, it's not really important. On to the trend phase 3. This phase is shown as soon as the closing price exceeds or falls below the last point 2. This is always represented by a differently coloured candle, and really by the closing price, but you can already see it here, and this is this wonderful combination, that the high is not displayed at this candle, but at the high at which trading has actually taken place in the order book. This, ladies and gentlemen, is the real revolution here in this Dalhousie package. The phase 4 is now eventually shown, technically correctly, as soon as there's no longer a higher high or respective lower low from the closing price. And precisely this is the beginning of the correction, no sooner and no later, but really only when there's no longer any higher high at the top or lower low at the bottom. Then the phase 4 begins immediately, because then up here the balance between supply and demand changes and the market goes into the correction. The trend phase 5 is displayed once the price has corrected at least 50% of the last movement. And this is where my experience in institutional trading comes into play, because big names seldom enter before this, but first let the market really correct itself. And only then is the phase 5 shown. The signal, ladies and gentlemen, ultimately arises as soon as in the superior time frame, the trend 1 and trend 2, to be seen up here on the right in this little box, are in the phase 4. At least phase 4, it can also be phase 5, but at least phase 4, which means the superior trend has to be in the correction and the trend to be traded, the small trend, has to be in the phase 5. And then these signals appear. And as you can see in the image, due to this unique combination of high, low and close, the signals are shown very, very early and coming from very deep out of the correction. This, ladies and gentlemen, is the final signal in our new Dow House setup. In the next video, I will then also show you some further features that have made their way into the Dow House Package Pro.